Hey, Allison.
Hey, Brian.
How are you? Hi, Sarah.
Brian,
Nice to meet you.
as well.
How you doing, Allison?
Great. No complaints. Ready for the weekend.
Awesome. It's good.
Yeah, how about you?
Uh, I would say ready for the weekend, but there's just more work to be done.
Oh, yeah, yeah, same here.
But I
But it
am ready for the weekend. Let me make sure I can spotlight you. Sarah, do you want to be spotlit as well? I'm guessing yes. I'll throw you two up there.
this is so
Um,
fancy.
I know. I'm learning all these cool tricks. I'll do me too. We'll just wait for people to trickle in. I'll do a very brief intro, and then I'll just toss it over to you.
That sounds great. We're super casual, so however we play this is good for us.
All right. Well, you fit in because I'm casual too. Um,
Oh, and Brian, were you able? I know we were kind of a little bit later than I would have liked, but did you get that PDF that I emailed you? Were you able to send that to the group?
I did. Let me. Oof, where should I send that? I can. Is it a link or no? No, it's not a link.
It's not late.
Okay.
Maybe one day.
Okay. Let me grab it. I'm gonna drop it in our Slack, and I'm gonna tell people that's where it is, and then I'll find a better place for it.
It's not a requirement or anything. We're just kind of going to be speaking to it a bit. So if somebody wanted to peruse it while they were listening.
Okay. Cool. It's in there now. Um, all right. What do you say we kick it off? All right. So Allison and Sarah are from Agate. Is that correct? CPA. Um, they are a small accounting and financial advisory firm um, that I was connected to, had a couple great conversations, and wanted to introduce them to the group because they focus on law firms and specifically kind of like small and boutique firms. Super knowledgeable, really nice people, and they agreed to work closely with Hay Counsel and the lawyers within our community to both be kind of like a knowledge source, but also obviously take the next step if anyone does need additional kind of like bookkeeping and tax and financial service type advice. Um, so without further ado, I'm going to pass it over to them because they got some cool stuff to go over regarding tax deductions and optimizing for tax for small firms as sort of like a nice value add thing for our community as we approach the fun times of tax season. So without any further ado, Allison, do you want to do a quick intro, or Sarah? I don't know who's taking it away. One of you two, and I will just fade into the background.
As Sarah will tell you, I'm the talker of the two. She'll be happy to tell you that. So, yeah, I'll probably do a little bit of talking here. But we're super casual folks. So please, anybody, feel free to interrupt us at any time. We'll present for just a little bit, maybe 15 minutes roughly. And then we really just want to help answer questions you have because that's really the value that we can add here today, I think. But so I'm Allison McLeod. I'm a CPA. I'm a certified financial planner as well. As Brian was saying, we work a lot with small, mid-sized law firms. We want to help y'all get your accounting done right, so you can do your taxes right, so you can grow your business, grow your wealth right. We know that a lot of you, the number side of things is a little bit scary, and that's our area of focus. So we want to make the scary things not so scary, and that's really what we're here for. Sarah's my partner. I'm located in Atlanta, Georgia. Sarah is in Northwest Arkansas, and we have law firm clients all over the country. So I'll dive in a little bit, and let me see if I can share my screen here. We have a little bit of a presentation, but don't worry. We are not going to read off of the slides or anything like that. We just want to use this to be a guide as to where we are. The first thing we want to talk about is your structure. We talked about us, is your tax structure. And this is one area where we see sometimes our clients are a little bit confused. And we know there's a lot going on in social media and chatting with your friends, your peers, your colleagues that make it also very confusing. I will say that think about your practice area and how complicated it can get and how confusing it can get. And tax law is no different. So make sure that you're working with somebody that tax attorney, tax accountant, somebody that has a really good focus on taxation and can help you as you're either starting your firm or expanding your firm, maybe new ownership, that sort of thing. Someone who can take you to that next level. One of the things that we see most often done wrong is that everybody just assumes I need an S corporation. S corporations, oddly enough to me, like just have this marketing around them. Like everybody just thinks they're the best thing ever, some kind of magical silver bullet. They really are not. They are just one type of many tax structures that are available to you. I say many, maybe there's 4 or 5 that are truly options, but you might want to do something a little bit different. S corporations work really well for firms that don't plan to scale. S corporations work really well for firms that are highly profitable. And that might not be you. You might be just starting out, and maybe you don't need that level of tax complexity because you're a solo and you're making $50,000 in your first year. But maybe go to year 2 and you're making $500,000. That might be a different analysis. Like I said, S corporations work really, really well when you're not trying to scale. Let's say you are trying to scale. You want to have a large firm. You want to have, at some point, you want to have 5, 6, 50 partners. An S corporation won't serve you at that level. It's too cumbersome to run. It's very inflexible. It's not going to work. So all of that to say that as you're setting things up, be concerned, be focused on what that looks like for you, that you're not getting yourself into a tax structure you don't need. They do take money to run them, right? You need somebody to help you do tax planning. Sarah's nodding her head. She's like, oh yeah, here comes some fees. You need somebody to run these structures for you. You need somebody to do the accounting for these structures. You need some level of accounting anyway. But as you find you have a business tax return filing that S corporations warrant, sometimes your accounting can get a little bit more in depth, a little bit more precise. And then you find you immediately need some help for that. So we do sometimes see folks that start off right off the bat with an S corporation. I was talking to a gentleman who's starting his own firm soon. He's going to start with a lot of clients, a lot of revenue, and he's in a state that requires his legal entity to be a corporation of some kind. So probably for him, an S corporation will make sense right off the bat. But just know that there are some other options available for you. That PDF that Brian put in your Slack has lots of discussion around that, and I suspect you have some questions. If you want to ask any questions now, we can answer those now. I know. Thank you, Dina. So much S Corp hype. Exactly. So if you would like to ask S Corp or tax structure or any other questions like that right now, we can do that. Or if you want to wait till the end, Brian, do you have a preference if we keep going or if we pause for a second here?
Pause. Yeah, go for a pause. I think that's probably the best way we'll keep it casual.
Love it. Any questions about tax structures, LLCs, F corporations? Dina?
I just have one question, which I've talked about. So I do M&A, so I deal with tax structuring. Have asked this question before to a lot of accountants I work with, and I feel like I never get a clear answer. So if you mistakenly, as I know lots of people have, mistakenly from a preference standpoint, set yourself up as an S Corp, you don't want to be an S Corp anymore. What exact, like, I've heard essentially there's not really an easy way to do that, but I don't continue to get clarity about what exactly that means. So like when you're making this decision for your own firm, if you did this wrong and wanted to change it, what happens?
Yeah, good question. We probably won't give you a clear answer either.
Yeah, okay.
So think about an S corporation as maybe a door that locks behind you. Once you go into the room, it's kind of done. You don't have to start off as an S corporation to be one. So it's flexible in that you could move to it. But once you're there, it's fairly inflexible. It doesn't readily let you come back out. For example, Dina, you may have seen this in your M&A work. S corporations have tons and tons of rules, like you can't do this, you have to do that. And when you break that rule, you don't necessarily get to revert back to what you had. Now you become a C corporation, which is probably extremely unideal for law firms. It certainly would be from our perspective. So, you know, there's not really hard and fast, oh, here's you just fill out this form and then you just check this box. And then, oh, all of a sudden you're not an S corporation anymore. Now you go back to being a single member LLC disregarded entity, or you go back to being, taxed as a partnership or something like that. The reason is because it's a corporate structure for tax purposes. Regardless of the underlying entity for state law purposes. So now you have issues around getting assets like accounts receivable, goodwill, et cetera, outside of an entity that's taxed as a corporate entity. And so now, is there some kind of toll charge to be paid as you undo that? So there's those kinds of questions. And that's why you don't have that's why all the CPAs, the horrible CPAs, are not getting a clear answer because there really isn't one.
Well, not horrible CPAs, more of just like the horrible CPAs that I've heard who just push everyone to do an S Corp. And I know it's bad. Thankfully, I'm not an S Corp. And this is not a asking for a friend situation, but that was helpful. Thank you.
Yeah, no, and I'm glad that you brought that up. And I honestly, we hate to see this. We see plenty of people with CPA behind their last name or even EA, enrolled agent behind their last name, who will happily tell you all their clients have S corporations. They all need to be S corporations. It's garbage. That's not true. Your tax answer is bespoke to you, just like anything else. Not everybody needs the same estate plan. Not everybody needs the same, everything, insurance, et cetera. Like everything is different. Neil.
Hey, thank you. Sorry, it's very dark in my house as there are thunderstorms in Northern California. Speaking of California, can you speak to jurisdictions like California, and truthfully, I don't know how many other ones there are, where if you're a solo, the only options you have are sole proprietorships and PCs, and just sort of like, and I'm ashamed to say this, maybe I'm not the only one on the call, or at least in the Hay Council community that thinks this. I don't really know, like, is a PC a state level? Like, what? Okay, tell me the relationship between PC and C Corp and S Corp, if you don't mind.
Yeah,
Thanks. I'll stop and listen.
No, this is a really good question, Neil. Nobody understands this. So maybe there's a couple of people on the call who do, but I would say most people don't. There's actually a discussion in that PDF that Brian put in Slack. We've got this chart in there for you. You'll never read that chart because it's like way overwhelming. But to break it down for you, entities are formed under state law. So you have, for that selection, you have probably a partnership, like a general partnership or a limited partnership. You can have a corporation, You can have a limited liability company or a limited liability partnership. There's probably, I don't know what we have in that chart, but maybe there's 6, 7, 10 different options for you. So you're basically going to the Secretary of State in whatever your applicable state is and saying, I need an entity. I want it to have this type of structure, which gives me certain treatments under corporate law. And so then the next question is, how does that entity get treated for tax purposes, for federal and for state? To your point, not all states are the same, but we can talk first about federal tax purposes. So for federal tax purposes, generally you're going to have an S corporation, we just talked about that, a C corporation, a partnership, which is confusing because you also have a partnership for like legal purposes under state law. And then you have what we call in tax world a disregarded entity, meaning it just doesn't really exist for income tax purposes, generally at the federal level. And so those are typically your options. There's maybe a couple other option or two, like trust or something, but those are the ones that you see. And so those kind of come together a bit like Legos. Like in theory, you can stack one, like the tax structure on top of the legal structure, but they don't all work that way. So for instance, if you want to have an S corporation, you can't start with a partnership under state law. So you need to start with either a limited liability company or you need to start with a corporation. So it's kind of a little bit of a layering effect. I don't know if that's helpful at all.
So if I understand you right, I mean, sorry, I'm just looking at other comments in case people are commenting on this. So if somebody hypothetically is a solo when they set up a PC in a place like California, is it fair or is it appropriate in context to say they can also set that up for federal tax purposes as an S corp as well, or I guess a C corp? I don't know why somebody would do that in those circumstances, but I assume like I guess what I'm trying to figure out is S corp versus C corp sort of a different kind of lever than PC versus LLP or a general partnership in a place like California or sole proprietorship?
Or any state, yes.
Okay, thank you.
Yeah, that's actually a really good phrase. It's a different lever, right? Yeah, I like that. Did that answer? I don't know if that helps a little bit, Neil.
Yeah, I'm just trying to figure out, like, for me personally, operating under sole proprietorship, I'm thinking this year, if I hit certain metrics, I will do a PC or set up a PC and pay myself a salary and all this other wonderful stuff. But if it has to be a C corp, then that would suck, right? Like then that changes the calculus, and I probably don't do it, right? But if I can set it up as an S corp, which again, I'm sadly for even by a lot of it, I don't know about this stuff. But from what you've indicated on the PDF, S corps have a tax advantage over C corps, and if it's possible to set up a PC as an S corp for federal tax purposes, that sounds like the way to go for me, and I'm sure a lot of other California solo practitioners who hit a certain level of scale.
Yeah, possibly. I would say your choice, Neil, is more specifically, it's not between S and C. Probably C is out the window. It's probably, do you want to stay a sole proprietorship versus moving to a PC/S corp? And that's an analysis. Like we do those kind of analyses for our clients. It's math, is what that is. It's also like, do you want to pay more to get payroll taxes done? And there's some administrative costs. And California loves state level taxes on entities. So for instance, there's like a ping for like LLCs to have a tax. I'm not sure if there's a corporate level tax, but I think that there is. I'd have to take a look.
I think it's a flat $800 franchise tax, from what I understand. And so, yeah.
Good questions. States matter. I see some talk in the chat about New York, another challenging state. Can someone help me decide which one we should look at? Is there a certain threshold when considering converting to an S corp? I converted having an LLC. Oh, Sarah already answered that one. Yep, I like Sarah's answer. I'll touch on that briefly too. So the chat in the about level, you'll hear a lot like, well, if you're making $100,000 a year, you need to be an S corp. Well, literally, people have been saying that for decades. Like, inflation alone would tell you that can't be right. So obviously, it's just marketing gimmicks to have like a specific number. But yeah, to Sarah's point, like profit does matter. If you're trying to reduce payroll taxes, which is what S corps are for, reducing self-employment taxes, which are pretty much the same thing. And then you need some level of profit to make that worthwhile, because you're going to need to file a separate business tax return. Again, you might need a separate, a better set of books than you've been keeping yourself if you've been keeping your own books. You need payroll taxes, payroll filings rather. So it gets very expensive to run these S corps when you're a sole owner. So you want to make sure that you have enough cash coming in that not only do you get enough tax benefit, but that you can also easily afford extra, annual filing costs, and it still makes it worthwhile. Because to our discussion earlier, once you're in that S corp, it's really hard to get out, if not impossible. Operate PLC in New York City and don't know if when it's sense to make the S corp election given the 8.85% business tax. That's a really good question, and honestly, I am not sure either. I don't think we have enough clients in New York. I don't know if we have any I don't know if we have any legal firms in New York right now at all. So I don't think we had to answer this question. I know that I do have at least one S corp client that's not a law firm in New York, and the default, unless you make an S election, is to just treat it like a C corporation. And we just do that because it's just easier and the tax is about the same. So I'd be happy to do some research if you want to email us. And we can, we'd be happy to take a look for you and just see what our thoughts are. Which
Thank
honestly,
you so much.
I think in all fairness, it will probably be me emailing our corporate attorneys who are in New York City and just asking them.
I appreciate that. Thank you.
Yeah, I'd be happy to. Might be too specific. Are there any benefits to running two entities? A corporation that hires a law firm to do legal works. Yep. Yeah, to Sarah's point, generally we see multiple structures when there's multiple owners. Oh my gosh, y'all, these are great questions. I could do this all day long. If you please stay along with others, but don't. Ooh. Rather than being a partner, creating an LLC and entering into the relationship so that you can still being a partner. Okay, so Wendy, I think that your question is super similar to Maria's about how do you come together, really? It doesn't have to be a legal entity, does it not? And I think to Sarah's point, like it's bespoke. It's, what is the facts and circumstances around your group? What are you trying to align on? We see firms that are coming together for legal and tax purposes that are just sharing expenses, right? It's eat what you kill scenario. And it's just in the back, it's like they've all got the same admin or paralegal or, research platform or whatever. And so they're all just sharing costs. That can be done inside a legal structure. That can be done outside a legal structure. Probably if you want the same marketing, right, and you want a brand and you want enterprise value that can continue without you, you're going to need a legal entity for that. Anything else kind of seems like fair game. I've been approached by someone who'd like me to work for her. I don't want to work for her, but I'm interested in maintaining my separate entity, but have coverage for some overhead. Yeah. So that sounds a bit like expense sharing. Wendy, if you'd like to, I'm in the interest of moving on. Sounds like you have a whole thing. Feel free to book some time with us, or just shoot us an email. We'd be happy to go over that with you and just brainstorm. Like Beat You Kill, I did that. Didn't set up my own LLC to control. Yeah. I mean, that's there's so many business models. Accounting firms are the same way. You'll see, like, profit sharing is based on production. What are you bringing in? And then you see other firms operate differently. A lot of it is practice area, depending on how you're getting your clients. If you're practicing corporate law, Eat What You Kill might make more sense because the referrals coming in are based on personal relationships, and that attorney's probably doing the work. But if you look at something like a PI firm where their business model is basically revenues being generated from their website, that URL is owned by the firm, etc., like it's probably going to be a little bit more enterprise value. Oh my gosh, this is great. Hopefully nobody's bored. Sarah will tell you I pretty much do talk this much all the time. So would y'all like to keep talking about tax structure, or would y'all like to talk about deductions? All right. And we'll move on to deductions. Let's see. Okay, well, I like talking about structure a little bit more, but let me see here. I think a few things that I'll say about tax deductions, just in general, to combat some social media nonsense, is there's this thought that, especially with things like our homes, our vehicles, if I use it for business, there is this big tax deduction available for me because I've used my car for business. I drove it to court one time. Let me dissuade you of that. I hate to say it, but really for items that tend to be personal in nature but have some business use, your tax deduction is going to be attributable only to your business use. So if you use your car one time a year for traveling to court, probably not going to be able to take much of any tax deduction on that. So when you see folks that are buying the Escalades and they're deducting $100,000 on their tax bill this year, probably a lot of that is just garbage. It's either not really happening or they're really setting themselves up for some tax exposure. Really, our take on tax deductions, just keep good books and records. I know it sounds really, really silly and really fundamental, but it's so true. Don't put your personal stuff on your business credit cards and business checking. Make sure you do have separate business checking accounts and operating account at Ulta if necessary, and a business credit card. Have those from day one. That will serve you so well. You're not sorting through what's personal, what's not, what could I possibly deduct. It's just all right there. It's all in those statements. We would, of course, it's self-serving, but we would recommend that you work with an accountant, somebody who's monitoring and managing and making sure that you can see a good profit and loss for the month and for the year. And all those deductions, for the most part, will be there. So really the boring record keeping is really where you get the most bang for your buck. A few other things I will say is probably this is, well, that's not tax deduction related. I was going to say be cash basis for tax purposes, not really a tax deduction, but it will help you out. The other thing that we see as a really nice tax deduction, and this is probably one that would benefit most of any law firms, is retirement plan contribution. This is a nice way to pay yourself in the future and get a tax deduction for it now. If you're small solo, setting up a SEP IRA, setting up a solo 401k, we love to see those as you grow. If you grow and have employees, a 401k. If you have high profit, especially if you don't have a whole big team to make that high profit happen, a cash balance plan can be a nice solution there too. We see, folks being able to put away, 6 figures in a year into a retirement plan. It really just depends on your size and what you have going on. But that's, having good books and records, considering a retirement plan, just keeping track of things during the year, not waiting until the end of the year. These are really the best ways to kind of get the deductions in. If anybody has any specific questions about, I pay for this, I pay for that, is it deductible? Now's a really good time to ask that. Zena is asking, what is a cash balance plan? So SEP IRAs and solo 401ks are a type of defined contribution plan, meaning on the front end, there's a certain amount of contributions you can make into the plan, and they're limited annually. And then at the end of your working years, when you go to retire, then you start drawing on whatever is in that account. A cash balance plan works more like a defined benefit plan. An actuary actually calculates every year what you can put into that plan with the goal of when you retire, you have hit a certain balance in that plan. And so it's a much more expensive type of plan to run, but for high earners, highly profitable firms, it's potentially a way to put a lot more into a retirement plan and get a lot more tax value on the front end. Tina, I love the questions. Anybody else have any questions about deductible, not deductible? You start trying to score, can you increase your income? What you really start generating revenue? want to minimize KPI, but would need to take more income initially. So Wendy, are you asking, when you say take income, are you asking about how much salary you should pay yourself? Got it. Okay. And so a few things there. The IRS expects that if your firm is structured as an S corporation, you as the S corporation owner are paying yourself a salary. Whatever the underlying state law situation is for your business, for federal tax purposes, you're an S corp. For federal tax purposes, you're considered an employee of your own company, and you need to take a salary. The question is, well, how much do you take? And there's no hard and fast rule on that. There are a lot of guidelines, and there's a lot of case law on this, especially with the pesky CPAs who try to take no salary out of their S corps. And the IRS loves to take us to tax court, and the attorneys as well. So what we do for our clients is we actually subscribe to a platform that helps us do what are called reasonable compensation studies. And they help us determine for the year upcoming, so for 2025, what our firms who are organized as S corps at the federal tax level should be in terms of reasonable comp for the year. So if for your practice area, for your location, it might be 80,000. For somebody else, it might be 120,000. And keep in mind, as that number goes up, you have, to Wendy's point, you have issues with the qualified business income deduction. You might have issues with retirement plan contributions, but you also experience less tax savings for your S corporation structure as your owner income, owner salary gets a little bit higher. Brian, how good do my records need to be? Oh, it's a good question. I don't really say organized receipts, but I do charge almost all my expenses to my business credit cards. Just not good at keeping receipts. Yeah, for sure. We totally recommend keeping receipts. Absolutely keep your statements, and make sure you're downloading your statements every single month. We have seen so many clients change banks, and your last bank does not care about you. You're never getting those statements, I assure you. So make sure you're keep downloading those statements every single month. You might need them a few years later. To the extent you can keep receipts, we absolutely encourage it, especially when the charge is related to travel or meals, because those receive extra IRS scrutiny just because they have an inherent personal component to them, or a presumed component. So keep the receipts as much as you can. Like Sarah says, this will be how you help prove that you have a valid deduction. Also, if you have anybody working for you, like maybe a counsel or some other contractor, make sure you give them a 1099 at the end of the year. If they're an employee, of course, they get a W-2, but otherwise, make sure they get a 1099. That substantiates your deduction for paying that other attorney, a counsel referral fee, something like that. Brian fears the audit. Don't fear the audit, but do respect the audit. But if you are afraid, we are here to help. Any deductions that people are forgetting to take, new business deductions, categories that people forget to take. Well, that's a good question. I would say sometimes we see folks forget to take a home office deduction if they legitimately work from home. You do have to have a place in your home. It doesn't have to be a whole room, but it does have to be a place where you regularly and exclusively do work for your firm. So that would be one. I'm kind of looking at a list over here. I can't think of anything that I see that people forget to claim entirely. If I think of something, Laurel, I'll come back to you. Alexander, any banks you recommend setting up? Looking for no minimum fees, very user-friendly. Oh, that's a good question. So firstly, especially if you need an IOLTA, which really could be anybody, I would go to your state bar, go to their website. They should have a list of IOLTA-friendly banks, and make sure you're selecting from there, firstly. I'm thinking of Chase. I know they're kind of big, but they have done a good job for at least a few of our clients. They don't have no complaints. They seem to not have any problems. We seem to have problems getting access, but once we're in, our clients themselves seem to do well. A lot of times we see folks be successful with local banks. So there's some that I could name, but like for example, in the Atlanta area, but they would be local for us. So I would start with the bar and start with your peers and see if there's any that people particularly like. Wendy, what are your thoughts on cash management like Profit First? I was just talking about Profit First with a new firm runner earlier today. Profit First will have you open up a lot of bank accounts, and that can complicate your accounting and it can raise your accounting fees. On the other hand, it can give you a nice way to park funds that are meant specifically for taxes or payroll or things like that. And quite openly, as Sarah will tell you, we have quite a few bank accounts ourselves that we like to park funds in. It's just really helpful for us to see that way. So I think from that perspective, Profit First is kind of nice. Kind of the whole concept of pay yourself first is nice. I don't think it's necessarily it's not a magic bullet for actually understanding the financial side of your business. And I will say also, it feels like at this point, Profit First is like this whole big mega movement. So I'd be just kind of careful about being swept up in it. But overall, we don't hate it. We don't really push it though, and we know that it does kind of increase the level of complexity on the accounting side. Make the 100%. We also can. Dear Dina, we will do everything we can to be able to deduct more meals. But I will say, one thing that we see is, and one thing that we work on, so obviously we're accounting and tax professionals, is we work to make sure that our clients' accounting files reflect tax treatments. So for instance, instead of sticking every single meal into a 50% deductible category, we do like hop in there and see what the quality of those transactions are. And we do look for meals that might be 100% deductible, like an office holiday party or something like that. So there are instances where you can deduct the whole thing. But I also hide from my family. Wendy, I think that's an appropriate use of your home office, as long as you're working. Can you create a Roth IRA and as a SEP IRA? Oh, there's a note. Yeah, that's a good question. I can't remember about if you can do Roth conversions or Roth contributions into SEPs either. Sarah, I was thinking no too, but maybe that's.
I know they changed something with that with the Secure 2.0 Act, but I'm not sure how it works now. I think it ends up getting reported on a 1099-R if you make a Roth contribution somehow, and there's something to do there. But we can look into that. Marie, if you want to shoot us an email, remind us about that. We'll do a little more research and can get back to you on that one.
I would say overall, though, we typically, for our solo runners, we typically like solo 401ks versus SEP IRAs just because you can put more into the solo 401k. I think the reason most people get SEP IRAs is because they're probably with well, I won't name names, but they're probably with a custodian already that cannot do the solo 401ks and so doesn't even recommend them. But generally, we like the solo 401ks better. Can you use a legitimate home office as part in your garage? Yeah. It's not part of the listed square footage. Oh, no, that's totally fine. It's totally fine. So we would look at that. I would just put that square footage in your numerator and denominator. And that percentage would be, multiply that by, utilities and security and all the other good home office expenses, your mortgage, interest, etc. Yep. Yes, or any basic knowledge you recommend your business owners have or books free? Oh, I love Maria's question. Basic knowledge. This one's hopefully you have a little bit of basic knowledge with our PDF document. Sarah, I can't think of like any just a general book to read. Do you have any thoughts on that?
I don't have any book recommendations necessarily, but I think the basic knowledge would, we kind of always start with keeping things simple. So doing that by separating a business account from your personal account, That's something we don't always see, but that always is just great, just a great basic place to start. Using advisors or talking with advisors, just like you all are legal advisors, work with an advisor on the accounting side that can help make sure you're making the right decisions along the way.
We'll give that some thought, Maria. Maybe we can come up with a good recommendation for a book or two. But yeah, to Sarah's point, like for us, like when we onboard a new accounting client, we meet with them monthly for a few months, make sure they can read their P&L and make sure we answer any questions they have, kind of dig into that. Because at the end of the day, you don't have to know how all businesses run. You only have to know how your business runs. And so you want to be able to ask really pointed questions. All right, Jason, how are you thinking about IRS audit risk in today's political climate? Oh, especially for middle income folks. What are the most egregious actions one can take to trigger? Yeah, for sure. The problem with assessing audit risk is that it's always like in advance. So I'm trying to tell somebody what I think their chances of IRS exam is 2 years from now, 3 years from now. Like I'll never be right. So I think it's really hard, but you can look at historic rates, and literally for decades, it's been very low. The IRS tends to audit folks that really have no money. I hate to say that. I don't agree with that stance. I think one, it's easier to audit those folks, and two, there's a presumption that folks with money are fudging their tax returns to look like they don't have money. But I don't know that that's necessarily true. I think there's easier ways to go after those folks, like just go after the non-filers, because there's a lot of those. But so you can look historically and see that probably, if you're earning $100,000, $200,000, $500,000 a year, the IRS is not auditing your income bracket in large percentages at all. One thing I can tell you, I'm gonna like talk on the other side of my mouth again. But one thing that has been commonly known among tax professionals, and the data bears this out, is that the IRS does audit Schedule Cs at a greater rate than it audits entities like S corporations and partnerships. Because again, it's easier to audit a Schedule C. So if you have an S corporation or a partnership, you probably are less likely to have an audit than if you have a Schedule C, like a sole proprietorship or a single member LLC, but not the best reason to have an S corp. What other actions can trigger? Yeah, absolutely. I see things on Schedule Cs or business tax returns that make no sense. And some of it I'm surprised that the IRS never comes after. But one thing I have heard recently that the IRS is coming after a little bit more is S corporation returns that have no or low owner salaries. So we always tell our clients to be cautious with their salaries at the S corp level, and I think maybe we might see more of that. But I don't know.
There, I'm gonna unlock the other door. Not that door, the door to your right, other door.
Maybe, just going back to the IRS exam, a partner told me years ago, pigs grow up and hogs get slaughtered. Like, just, be reasonable with your mileage deduction, be reasonable with your vehicle cost, be reasonable again with your meals. If you're a solo attorney and you work from home and you have, you do general counsel work and you have 10 large clients, how much you really need to spend on meals every day. So be reasonable. Let's see. Great, thank you. About taking in a lot. Maria, you asked about how about taking in a lot of filing fees? Can you tell me a little bit more about what you're looking to?
Yes, I just feel like for example, some of our filing fees, like for example, when you file a trademark, there's a $350 filing fee to the USPTO, and we collect that from our clients and then pay it to the USPTO. And I always feel like it's such a huge number that, and I think it's just like reported on the tax forms as like, deduction filing fee. And it always just surprises me that that's not like some red flag for them, or if there's some different way it should be done.
Yeah. Sarah, let me answer Maria's question, but Sarah, would you pull up the audit technique guide? for law firms. There's a new one on the IRS website as of like last 2024. We might have it in our file somewhere. So Maria, yeah, we would label that as filing fees, or maybe a more broader umbrella term. We might just call it client costs. Hi, Alexander. Yeah, I have not seen any issues historically with showing any sort of client costs or filing fees or anything along those lines. There's certainly an expectation by the IRS that law firms are fronting some of these costs or simply just paying them on behalf of clients, and that shouldn't be an issue. Where you want to be careful is that to an extent, the IRS considers fees that you pay for a client, so court costs, filing fees, transcript, anything like that, like really the client kind of should pay, but they're not gonna because maybe it's a contingency case and they don't have any money to pay it, or maybe it's just administrative convenience, you're paying it for them. What the IRS is gonna say is that's kind of like a loan to the client. They want you to treat it as like a loan due from the client and then not put it on your profit and loss and expense it until that matter is closed. Case is lost, or, you know, the patent comes in, or whatever that is. Yeah, I will say. And so if Sarah can find that, or maybe we can send that to Brian later. The IRS has what they call the audit technique guide. They do this for a variety of industries, where it's basically the IRS telling their examiners how to approach an audit for a particular industry. Law firms are one of them. They update these once a decade, once in a blue moon, and the one for attorneys to get updated late last year. I think it was late last year. And yeah, it talks really about these advanced client costs, client fees, et cetera. So that's what made me think of that. But just in general, no, I don't see an issue with deducting those costs as long as it's the right time to deduct those costs. I don't see the IRS being concerned about the size volume of that. Thanks, Sarah. Any other questions about deductions? I'll move us on to estimated time. Oh, Dina, yes.
Sorry, I did have one. And I think it kind of went along with the prior question a little bit from Maria, but if you are fronting costs, let's say for filing fees or lien searches or things like that, that you get reimbursed for, and then when you get your 1099 NEC, that's included. I know you can just then take that as so I'm a single member LLC, so take it on my Schedule C, but if certain of your clients don't send you the 1099, should you then go back and add back in those expenses, even though, because it wasn't reported to me, or is it fine for the rest of that to just actually report what I truly received rather than a reimbursement?
Yep. So, Dina, you don't have to worry about whether clients send you 1099s or not.
Yep.
Yeah, you keep your accounting, you know what's revenue, you know what are deductions, you know what's maybe held in trust or whatever else. So you report that on your tax return as you need to. The only time you need to be concerned is if you look at your total revenue for the year, say it's like 250,000, and then you look at the 1099s that your clients report to you, and let's say you add all those up and it says 400,000. You really need to be concerned if the sum of the 1099s you receive is in excess of the revenue you're going to report on your personal or business tax return. But as long as it's that, you know, the exact number or less, or, you know, you don't care what they report, you don't care, because that's really on their end.
Okay, so it sounds like if they did do it, I should just then subtract out report that amount and then subtract out the expenses. But for those who didn't, I can actually do it the right way of what I actually received. Okay, cool. Thank you.
Yeah, for sure. We'll talk briefly about estimated taxes. So anybody, before I just keep yakking, anyone have any specific questions about estimated taxes? And I can address those. We'll let those hop in the chat. So what we see is often, especially if someone is coming from a firm where they've gotten a W-2 for a long time, they've had withholding. That withholding has always been adequate so that when they come time to file their tax returns in April, they are getting a refund or maybe owing, but it's not a lot. When you switch it up and now you're running your own firm, it doesn't work that way anymore. Either you have an S corporation and you're in charge of your own withholding and your own salary, and it's a little bit different, or maybe you have a sole proprietorship or a partnership and there's no withholding for you at all. The IRS still expects that you're paying them something, and maybe your state as well, depending on your state, that you're paying something in as you go throughout the year. So you also want to pay in something as you go throughout the year, because a big chunk of change leaving your pocket in April can be quite distressing. So for our clients, we are trying to help them manage and monitor that, understanding that what you owe is a function of two numbers, and it's your liability and it's also your payments. And so trying to keep those in line so that you have a good understanding of where you'll be and what's going on. We get asked all the time, I'm running a new business, I'm running a new firm. Do I need to make estimated tax payments? And that is such a bespoke question. Even more so, I think, than questions of structure, more so than questions about tax deductions, because you might be married and maybe your spouse has enough withholding to cover both of you the first year, because maybe your firm is, running at a loss if you don't have clients. Or maybe your spouse never has enough withholding, and your withholding has always been enough to cover them. Well, now you're going to need to make estimated tax payments for your firm's profits and also to cover your spouse. Or maybe your spouse needs to go back to their employer and raise their withholdings. So there's really a lot going on there. I would say, to the extent that you can, look at your profit for the month, set aside a third of it, put it in another account. Just might go back to the profits first model, but just have it set aside just for taxes. If you want to make estimated tax payments, do that. If you want to wait until the end of the year when you file your tax returns and see what that looks like, do that. I think a third might be not enough for some people and might be too much for others, but it gets you in the ballpark. So that's generally what we recommend if we don't have insight into somebody's tax situation. Maybe they're not a client, or maybe they're just starting out and have no idea what's about to happen. That's a decent rule of thumb. Keep in mind, of course, it means you're keeping up with your accounting records throughout the year to even know what that 1/3 could be based on. But that's how we approach it for folks that are just starting their firms. Really, the big deal is making sure you're paid in by April. If you start paying late, that's a little bit different. Now the IRS is going to send you love letters. We want our money. We want you to get into an installment plan. Same with state, depending on your state. But anything that you prepay up until then just minimizes your underpayment penalties, which are really more like interest on a loan. So as long as you're prepaying or setting aside, and you can pay everything in April, and you can get on a schedule where you're still setting aside into the following year for that year, you're probably doing fine. Again, it's hard to speak specifically about estimated taxes, but we know a lot of people, this is one of the top 3 questions we're always asked with new firms is do I pay? How much do I pay? So it is a really tailored answer. Apparently, estimated taxes is really not a hot button topic for our group. Oh, Wendy's saving us here. Let's see. A question: what about expenses incurred before you actually start running? I know with SDRs. Yeah. Same here, Wendy. So you really need to be open for business. You may not have business, but you need to be open for business. So let's say you launch your firm in December and you don't have any clients until February 1st. Maybe it takes a couple of months for the marketing to work. If you're open for business in December, you can deduct maybe not all, but most of your expenses. You're welcome, Jason. But you can deduct most of your expenses. There may be some startup costs, Wendy, that have to be quote unquote capitalized and expensed over time, but most likely you'll be able to deduct everything in that first year that you're open for business. What other questions do we have? Might be at the end. Thank you. Thank you very much.
Awesome. That was really impressive. I don't know how many words were actually spoken, but you just flew through those, answered every single question. Both of you. The tag team was great with Sarah in the chat. That was like you guys ran a clinic. So I'm super grateful. I know everyone on the call is super grateful for that. It was really, really great.
Aw. Well, we love doing this. We love helping people. We know all this stuff is like way more confusing than it needs to be. If anybody wants to just email us and ask any specific questions, I mean, you're welcome to. If you want to have a longer call with us, you're welcome to. Like, we just want to help.
Awesome.
Can you
Yeah.
spell the firm's name again? Is it Agate?
Yeah.
Agate?
Great. I'll make sure everyone has your information. And then just as a reminder, we're looking to work more closely with Agate and just keep the channel of information flowing. So Allison, Sarah, and I will kind of put our heads together on ways we can do more of these webinars and just have a little bit more of an active role in this community, because we obviously are really looking for trusted advisors in all different facets of legal practice, and this being a huge one of those. So I am, again, super grateful. You shared so much information, and I think oftentimes when we do webinars or anyone does webinars, a lot of it's very surface level and not super pragmatic, but you just tore through these questions and really helped out. So yeah, can't thank you enough for that. So hopefully we can continue working together, and thanks again.
Well, we enjoyed it. I hope it was helpful. If you have any questions, let us know.
All right. Thanks everyone for joining, and 4 minutes early. So really efficient too.
Awesome. Have a
All
good
right.
day.
See y'all.
Thank you.